All right, welcome back to the Gray Report. Joined again by Dr. Matt Bosnagel. Matt, how are we doing
Hello.
this week?
Pretty good. It's been a really interesting week. A lot of up and downs and a lot of stuff where even as it was happening, I was like, this is going in the Gray Report. So fun from my perspective.
So Matt, it's always a fun and exciting week on the Gray Report, but this last week has been exceptional because, we recorded last week's episode right before the Fed meeting press conference. The next day, they come out with this jobs report and then a revision to the prior 3 months jobs report that basically shows we really haven't added that many jobs to the economy. So tons to talk about. It is really having everyone rethink the macro economy. We talk about macro a lot here in the Gray Report. Talk about interest rates. We talk about the Fed. We talk about how that relates to commercial real estate. And I can't think of another pivot point like we may have seen last week. I know we're going to talk about that, the whole segment, but there's this other idea that you've mentioned that you've seen in a number of publications, this concept of this generational reset for commercial real estate. We talked about it. There's like a John Burns research consulting piece we talked about a couple of weeks ago, a couple of new piece from, I think, CBRE. What's the conversation about this reset? What are we resetting here? What's going on?
Well, this is referring to the long-term cool down that we've had of the past 2 years, and the argument is that the reset is that we're going to stop cooling down and we're going to start recovering. I think that the overall thesis is after long periods of cooling prices, there tends to be an accelerated increase in prices, and they are comparing the cool downs in the early 90s and the Great Financial Crisis as two other periods where really where there was cool downs and then subsequent increases on the tail of those cool downs. There's a lot of reasons to think that this could be true. I think that there's what I was gaming out really after reading this was the things that I thought maybe needed to happen or were already happening in order for this to be kind of a springboard to a recovery. I think that there's one thing that characterizes this market right now is low sales activity, and it is like 50% lower or even less maybe in some cases. People aren't buying and selling commercial real estate right now like they were pre-pandemic. And this is just 50% lower than pre-pandemic, let alone the huge, massive amount of sales that we had in like 2021 and 2022. Sorry.
Well, I would say one of the reasons that I think folks aren't buying real estate, Matt, is because this idea that prices need to be lower. There are buyers at higher cap rates at lower prices. And it's the idea that we need to wait for a final drop in pricing to be able to actually transact. But that has been the wish for the last several years. And we have seen a material drop in pricing. It doesn't feel like it's happened overnight, but we have.
Yep. I think you said it really perfectly. You're looking for cheap, but it's cheap today. Cheap's not going to be in the future. And it has been, and they make a huge point here. They say, most industry benchmark indices show aggregate U.S. CRE pricing going down anywhere from 13 to 21% from their mid 2022 peak. Aggregate CRE valuations endured steeper declines in only two other periods over the last 40 years, which was the early 90s and the Great Financial Crisis. And you can see that this how things are trending. In the early 90s, it did fall and then it sharply rose. And again during the cool down to like the dot-com crash, things went down, and then during the Great Financial Crisis, prices went down and then they came bounding back up. This is a several years long cool down, I think, and the length of the cool down is important because they're saying that it really builds up this, I think, it's pent up demand for future growth. Now and I think that's one of the things that I wanted to highlight here. And they did say that it's not hyperbolic to characterize the latest decline in U.S. commercial property values as a generational reset. That working theme then is, how does this multifamily market spring back to life? I think one is this cooled off investment market, which I've just described. I do think, though, that there is that risk, right? Because my thought is if things were really active and people were buying and they were really optimistic, like they were in 2022 and and let me pull up this bonus chart here. Like in
Q4 content.
Yeah, exactly. In Q4 2021, there was a lot of sales activity. That was, everyone thought things could only go up. This was the most buying, and also the prices were essentially at their peak. Now, if you bought then, when everyone was positive, everyone was hopeful, when the universal optimism almost, then you would have seen an incredible decline. And that tends to be sometimes what happens in investment markets in general. People always think that the good times are going to keep rolling, and people kind of also tend to think that the bad times will continue to kind of stagnate. I think that's behind what people are a little bit. I think that's also a little bit of behind people looking for further price declines, is like, well, they're also at the same time that they're not expecting prices to, or they're waiting for further price declines, they're also not expecting that jump up. And that's, I think, where you can find the value is like, well, no, we're absent the assumption of value increases. We're not absent the assumption of value decreases. I think that's the problem is like, yeah.
I think people are so anxious for this recovery. And I think that it can be true that, okay, maybe we don't see additional price declines, which there's still a lot of folks out there, again, that want to see lower prices because they say, look, with the 10-year treasury at, I mean, even if it's lower today at, 423, 425, it's still above 4, which is too high. And to be able to transact, we need to see cap rates at least, closer to the 6% range, even higher than that. We're not seeing that. Yeah. Well, persistently high interest rates, maybe you will see that, but we're it's not present today.
Oh yeah, I think that's the big factor right there to unlock everything. Now, I kind of saved that for last, but it is lower interest rates. I can see a gradual recovery, a slow repricing if interest rates remain where they are. But if in order to like release all this energy for things to spring back upwards, you're going to need lower interest rates. Otherwise, it's just going to it will incline, but not as fast.
I think the only way we're going to get interest rates that low to really cause a major springboard like we're talking about, which I think is kind of a fever dream of commercial real estate brokers right now, and developers. I'm not saying it's impossible, but I'd say it's unlikely. Because look at this chart that you're showing right now. Go look at 2009 to 2022. You don't see a springboard for more than a decade, Matt. Yeah, it takes 12. It takes 11 years, 13 years to get to like a big run up. Because that run up, that during COVID, that only happened because the 10-year Treasury went to 50 basis points. So for short-term rates were 0, and so the only way for that type of springboard would be if there was some sort of economic event that forced interest rates to go to 0. We would need that recession to happen. And I think it's absolutely possible that we have a slow burn and it becomes a war of attrition. And there is a reset, but it's a slow reset, and rates normalize slightly lower, cap rates normalize, and prices rise over time. And then that's this reset. Yeah. The only real true reset that we've been talking about for years, Matt, would be some sort of recession that would cause enough transaction activity to flush out all of these bad zombie deals that were done during that period of 2021 and 2022, flush them out of the system, wipe the slate clean. That's the true reset. Otherwise, it's a war of attrition that will take place over the next decade, not over the next year. And I think that's the base case that investors need to be prepared for.
Yeah. One of the reports that we didn't have time to cover on this week's Gray Report, still very interesting, from TREP about the drag in commercial real estate loans and commercial real estate mortgages, and how it's not necessarily delinquent or past their loan maturities, but they're like working things out in a myriad of different ways. And it does seem like banks are kind of still adjusting and still reevaluating what their expectations are for some of these loans. And there's a weird limbo status. It's one of a number of things where these borrowers are able to survive past their loan maturities. So that's something that I'll watch and I'll be digging into.
I think the can, not for all, I think the can is still getting kicked down the road for some borrowers, because I think it's just like this recurring theme of Groundhog Day that the lenders are saying, we think rates are going to be low here in the next 6 months. We don't want to start the process now. And it's literally this cycle of every 6 months. Like, we think that, rates are going to be lower here in the near future.
Yeah, I totally
get right.
Yeah, I do think you made a really good point. I think that interest rates, there is a lot of hope and reliance perhaps on interest rates going down quickly, or going down to the levels that we saw during the pandemic. And to think of what it took, which was a pandemic, to get interest rates that low, there may be elements of a delusion that people think that that's going to happen again just because it happened before. Well, I think short of a pandemic, interest rates won't get that low. And so we probably, won't see that skyrocketing increase in valuations or sales activity or anything. They're not going to be, kicking the door down trying to invest like they were in 2021. But I still think that a trajectory, at least like some kind of roadmap towards lower rates, will hopefully get more investors interested, and it will see some valuation increases, just not the bonanza that there was in 2021.
Yeah, no, I think to your point, and I think that from the piece's point, the article's point, I think that is true. It doesn't have to be necessarily so binary, in that, if long-term rates really do come in below that 10%, that 4% range. If the 10-year Treasury is below 10%, it's kind of in that 350 range. A lot of deals can get done. I guess the caveat that rent growth kind of at least maintains maybe or tries to pick up some momentum, which I know we're going to talk about in a little bit, and whether that's because of the lease up competition or if that's a slowing economy. But certainly interest rates coming down would help, and I think there's enough bullish optimism for the multifamily sector over the next decade or so, that even some short-term weakness in rent growth, if the financing rates were attractive enough and you could at least get some of that positive leverage on more deals, I think at least you'll see the market moving and it'll be transacting. Now, some folks may say that that's not an attractive because rent growth is slow, but you'll at least be able to achieve positive leverage for those that have that longer term vision.
I think that this is this kind of like cooler. I think that the low rent growth now is at least balanced, and I would maybe even overbalance towards the idea of the supply balance, the supply coming down in the years to come. So this is what they have in Cushman Wakefield, and this is part of where I got that figure of this figure where it says it costs. The apartment prices have gone up 14% since the pandemic, and apartment construction prices have gone up 35%. So more than twice as much it costs to build a new apartment, whereas the actual value of apartments in general, which includes older apartments, have only gone up less than half of that. 14%. So I think that's one of the pieces of the puzzle to maybe getting this recovery is this positive or at least a more balanced supply trends. The supply trends are favorable for investment. I also think that the demand that we've seen in the apartment market is enough to also similarly kind of counteract the the negative implications of lower rent growth. So we are seeing a lot of absorption, record numbers of absorption. That's at least a rejoinder you can have to people that are kind of bummed out. I would also say that this is the low rent growth is a sign of uneven performance, which I think is another factor in finding the deal. Like this is it's along the same lines of, well, it's not going to be all prices going up everywhere at once. Otherwise, that'd be a kind of like an inflationary bubble or something where kind of similar to how it was in 2021. It's going to be uneven. There's going to be places like the Sun Belt, maybe, where they overbuilt, where they'll continue to have lower rent growth and probably sliding property values. Whereas in other places in the Northeast and Midwest, and we will see this on the map in the apartment list, the rent growth is higher. The property values have a little bit more of a positive trajectory because the supply wasn't as mismatched.
Can I make just call it a comment? I don't know what you want to call it, Matt. But, we talk about demand a lot, and it's true. Demand it looks really strong right now, whether that's just affordability because single family homes are so expensive. Never seen this amount of apartment demand in a long time. Okay. Mm-hmm. That being said, like what good is demand other than saying like, well, it could be worse. Like if you're in Austin right now, if you're in the Sun Belt and we tell you you're seeing record demand, but your rent growth is still negative. What does record demand do if it leads to negative sustained rent growth? And so while it's a metric, it's important. We should acknowledge it and say, look, this is like the market isn't that bad, but demand. Again, it's important. Just like in isolation, it only means so much, and where it's translating to, it's not necessarily enough to really push these markets into like a positive growth trajectory, which I think is just fascinating, kind of in the time that we're in right now. But I think don't be fooled just because it's high demand. Yeah, it's high demand because it's incredibly high supply, and so the net is not necessarily translating into high growth, which people think high demand means high growth.
Yeah. Now it's going to vary from source to source, but it looks like on this quarterly map I have here from CoStar, net deliveries have outpaced absorption for every quarter since Q4 2021. It does look like there are challenges in the apartment market, but I do think that at the very least there is some signs of an improving, more balanced supply trajectory, of a lot of demand, which again it may not translate to rent growth, especially in light of the enormous amount of supply. But if that demand continues and supply peters off, then that is probably going to lead to stronger rent growth. This is all to say
it is assuming that demand remains elevated. A lot of times demand kind of follows supply, and so as supply recedes, we may see that demand recede as well, kind of step by step.
So ultimately it is just reflective of the challenges, the near-term challenges that there are, and that's one of the takeaways of Cushman Wakefield, is that you need to adopt this medium to long-term perspective. Well, and then they said investors should measure their expectations for the near term. I think that you just need to figure out how to manage your expenses and how things make sense in the near term, because these near-term problems, if they persist for long enough, and I'd say 4 or 3 years, is long enough. If they persist long enough, they become long-term problems. It's not just a hill you get over and then you're fine. It's a plateau of elevated costs and low low rent growth that can really hurt your bottom line if you're caught on the wrong side of it. And I think a lot of people are. And I wonder if they're like their hold periods are being extended for some of the deals. If they're saying, the last 3 years are doing bad. Well, good thing now it's a 10-year thing, so we'll get over that. But it does seem like a lot of things are going to be deferred. I do think ultimately, though, in the market, the survivors are going to be able to be the ones that operate in the near term, have their eyes towards the long term, but don't have like long-term gains as like their one shining thing. I think they need to be able to make things work from the day to day, and that's part of the equation. But maybe that's a simple thing.
I know. I think what you're basically saying, Matt, or correct me if I'm wrong, and it's what we've always believed, the cornerstone to our investment philosophy of Great Capital is buy for cash flow. You want to buy something that's cash flowing today and being comfortable with the return today, with modest assumptions, being able to grow that cash flow and not bet everything on appreciation that relies often, not always, on outside macro forces. Unless it's something that, it's appreciation that you're forcing through, some sort of value add in the work that you're doing.
John Chang says, keep your eyes on the horizon. I think it's a great comment. It does reflect the long-term nature of real estate. But I think if you don't look down sometimes, you're going to hit some real stumbling blocks that, that may be in front of you. So that's all I'm saying. And I think that people are, after a few years of this, it's no longer a thing of like, well, now it's hard, but but in a couple years, things are going to get better. I think people are solving for the now right now. And that's probably the assumptions that they're bringing forward when they're coming to buy an apartment. It's not like, well, got to get over this temporary thing. They're kind of underwriting for it and expecting it to continue in a way that they weren't maybe in 2023, or even 2024.
Oh, Matt, I mean, especially, in 2021, 2022, people were buying these again. That's why everyone was buying on short-term bridge loans. People thought they were going to make millions of dollars within 18 months or less.
Yeah.
They thought they were going to hold it for 12 months. Cap rates would be, somehow they thought they were going to be like 2% or something, and they were going to get 25% rent growth, and they were going to flip out of it.